Let's take a collective deep breath. In this explainer, we're going to completely restructure how you view the market. We're stepping away from the hype, all the noise and the absolute exhaustion of constant action, and we're moving into the calm, quiet reality of professional execution. Because the central truth we're unpacking today is actually pretty simple. Long-term success? It isn't built on emotional intensity. It's built on survival.
Now, we really have to start by acknowledging the visceral reality of trading pain. We've all been there, right? The exhaustion of forcing setups, the heavy pressure of a payout you desperately need, or just the absolute confidence collapse that follows a blown account. When you take a loss, your brain literally screams at you to fix it, immediately. But here's the thing, that emotional urgency, that is exactly what destroys your precision.
And that urgency leads right into a very dangerous emotional spiral. You take a hit, and suddenly you're revenge trading. Out of pure desperation, you might increase your position size, recklessly over-leveraging just to make it back in one single shot. You completely abandon your process, you ignore your timing, and ultimately, you end up destroying a system that is otherwise perfectly, mathematically profitable.
It's incredibly fascinating to look at the stark contrast between that dopamine-driven retail habit and the calm survival mechanics of an institution. The retail trader is out there chasing candles, reacting to every single tick, and viewing a loss as a deeply personal failure. But the institutional operator, they're focused purely on capital preservation, process integrity, and risk control. To them, a small loss is just a standard business expense. There's this massive illusion out there that the big players are perfectly predicting market tops and bottoms. Honestly, they aren't. Banks and large institutions are simply paid to stay alive. They operate on highly structured risk models, and they will gladly choose small, boring profits every single day over taking on the risk of one large catastrophic drawdown. They control risk first, because if they don't, the game's over. So that brings us to the ultimate institutional hierarchy, and I really want you to notice where profit sits on this list. It's dead last. Step 1 is survival. 2 is risk control. 3 is process. And finally, 4 is profit. Look, if you don't survive, you literally have no capital to execute your process. And without capital and process, profit is completely impossible. Your absolute primary job is just to ensure you're alive to trade tomorrow.
To survive, you really have to shift your paradigm around losing. You've got to start budgeting your losses as operational overhead. Think of it like a restaurant, right? A restaurant buys ingredients and just accepts a certain amount of spoilage as a business expense. A small trading loss is exactly the same thing. By accepting this logically, you completely neutralize the emotional sting. You stop negotiating with the loss, and you just file it away as a simple cost of doing business. And this brings us to a really brilliant, strict mechanical rule from our source material, the number 7. Before you even think about entering a trade, you have to score your emotional neutrality on a scale of 1 to 10. A score of 7 is the bare minimum required to execute. If you're sitting at a 6, maybe you're a bit anxious or frustrated, you simply do not have permission to touch the mouse. This rule is entirely non-negotiable. When you do take a loss, you have to follow a mechanical protocol. At minute 0, your stop is triggered. Now, the data reveals a truly fascinating psychological trap. The window between 12 and 20 minutes after a stopout is your absolute highest revenge risk phase. Your brain is desperately trying to fix the pain. Therefore, a mandatory 20-minute cooling period is your ultimate survival tool. No charts, no analysis, and absolutely no re-entry until your neutrality is fully restored. Which leads us to the skill of doing nothing, and really respecting time and liquidity. Let's just shift the pace here for a second and reflect on a rather profound truth. Simply sitting on your hands and waiting for the right environmental alignment is actually a high-tier skill. It isn't wasted time, it's active preservation. Let's look closely at the mechanics of time. The framework clearly dictates that you should never trade the first 12 minutes of any session hour. Why? Well, because those opening minutes are strictly for institutional accumulation and manipulation. It's just algorithms pricing the market and building liquidity pools. It is really not an environment for your participation. Your job is to observe and just wait for the real delivery to begin. You see, an actual institutional setup requires far more than just a pattern on a chart. It demands a valid session timing window, a confirmed sweep of liquidity, clean displacement in price, and crucially, a neutral emotional state with zero emotional urgency. If you try to force these setups in the wrong environment, the resulting overtrading will completely destroy your clarity. Basically, if your heart is racing, or if you're glued to the screen literally cheering for a candle to move, you're gambling.
Professional trading is a highly repetitive, mechanical business process. It's totally devoid of hype. It is, quite frankly, boring. And you know what? If it's boring, it means you're doing it right. Big money does not operate in erratic emotional chaos. It operates systematically.
And that requires a major paradigm shift, rebuilding your trader identity from the ground up. You have to actively declare that you're no longer a reactive retail trader. You're not a victim of the market's randomness anymore. You are a structured, emotionally stable market operator. The entire foundation of that new identity relies on completely redefining one exact word: consistency. Most retail traders think consistency means making money every single day, but that's a trap. Real consistency is behavioral repeatability under uncertainty. It means executing the exact same rules and applying the exact same risk management completely regardless of whether your last trade was a win or a loss. Your mental energy really needs to be ruthlessly allocated. Think about it like this. 80% of your focus must be entirely dedicated to process integrity, following your rules flawlessly. 15% goes to managing your risk, and a mere 5% of your focus should actually be on the profit outcome. Because if you rigorously protect the process and manage the risk, those profit outcomes will mechanically take care of themselves. Now, a huge part of that process integrity is knowing exactly when to stop. You absolutely must have thesis completion rules. If price reaches an institutional target, you stop. If your emotional neutrality drops below a 7, you stop. Walking away and ending the session early when your thesis is complete is quite literally how you survive. It protects you against the devastating effects of over-engagement and giving everything right back to the market.
I really want this reality to settle in your mind right now. Doing nothing is a high-scale activity. It takes incredible maturity to watch the market move, realize it doesn't fit your strict parameters, and then actively decide to protect your capital instead of chasing the action.
When the charts are chaotic, when algorithms are just sweeping highs and lows out there, standard retail patterns are going to fail. Only timing survives the noise. By deliberately restricting your participation to highly probable windows of time, you effectively protect yourself from the randomness that bankrupts emotional traders.
Remember, patience creates precision. Precision is definitely not born from speed. It's not jumping into a trade the exact second a level is touched. Real precision is born from the immense, quiet discipline that's required to wait for perfect alignment, an alignment of time, price, liquidity, and most importantly, your own emotional state.
Because ultimately, you cannot control what the market is going to do next. Nobody can perfectly predict the future. The only thing you have absolute control over is your own structured response. So your goal is consistency of self. You're mastering your own behaviors. You're not trying to master the market.
The market is always going to present another setup. The algorithms will always cycle again tomorrow. The only real question is, will you have the capital and the mental clarity to take advantage of it? The traders who survive emotionally and financially long enough to repeatedly execute their process are the only ones who ultimately achieve sustainable consistency. So protect your capital, protect your clarity, because at the end of the day, survival creates opportunity.